JP Morgan pays up big, Lloyd Blankfein is bullish, and we've got words for the inventor of pumpkin bread. You're in the right place, folks, because this is where the money is. Welcome to the show, folks. I am Matt Copenheffer, and sitting right next to me here is David Hanson. David, today you are wearing a pair of electric blue pants. I'm wondering, do you expect that the calendar is going to start moving in reverse? We're going to hit Labor Day again and go right back into summer.
We're still in summer. It is not fall yet. I think fall is maybe next couple days.
It's chilly outside. I wake up in the morning. I'm chilly in the morning. To me, that is fall.
I was surprised, actually. I was listening to the news this morning, and fall actually starts on an exact minute. They have it down to the minute when this starts. It's like 4:44 p.m. in a couple days. So fall, not quite here
So
yet.
Right at that minute, do those pants go in the closet?
They're tearaways, like an NBA player. I could just rip them right off.
All right, we've got a great show today. We're going to start, as always, with the headlines. And the first one, I know you're going to love talking about this, David, because it's about the Federal Reserve. CNN headline says, Federal Reserve says no taper. You got to be happy.
To much surprise, I guess. I mean,
let me read you a little bit from the article, the intro here. Since last September, the Fed has been buying $85 billion in bonds each month in an effort to lower long-term interest rates, particularly on mortgages. The Fed plans to keep that strategy in place for the time being and will reevaluate the policy at its next meeting at the end of October.
Mm-hmm. I guess you have to look at it. I mean, they're being cautious in terms of they really want to keep the support in there. I guess you could read it as they don't think the economy is that strong, and it's hard to argue with it considering some of the numbers we've seen other than housing numbers, which have looked great over the last year or so.
Yeah.
Unemployment, not great. GDP growth, certainly not growing at 3-4%. So it's really hard to argue with it.
Well, the recent numbers in particular have not been particularly comforting. And even though the last labor report, the last employment report was not horrible, the revisions were really big. The downward revisions were really big. And we had pointed that out on this show. Justin Wolfers had actually been, we're a fan of his on Twitter. He had been in front of this and he pointed that out. He actually expected that was going to be the reason for the no taper. Of course, we don't exactly know why the Fed made that decision, but the numbers don't look particularly good. I kind of hate all of this. I hate the circus. I know you don't like all of the following of the Fed. I'm not a big fan of it. I would like to see some real solutions here, and a big part of that would be Congress doing something. I know I probably will have a lot of people disagree with me on this, but I think the federal government needs to step in with some fiscal support. Monetary policy has done as much as it could possibly do, and Bernanke is basically, I hate this phrase, but pushing on a string at this point. We need some fiscal stimulus as well. We need Congress to do something, right, as opposed to continue to try to push it with the monetary policy.
Speaking of a lot of money, going to our next headline, JP Morgan agreeing to pay $920 million for London Whale loss. Just keeps getting higher. We thought it was $800 million. Now, with the extra payment to the Federal Reserve, who's now getting a slice of this pie. Is this over?
It'll be $4 or $5 billion by next week.
It's just going to keep going. Is this over? Is this? I know you said it's not a concern, but that's $920 million. That's not in shareholder equity. That's not good.
The $920 million to me isn't the concern, right? The earning power of JP Morgan is so huge that it's not nothing. I mean, it's $920 million, and certainly it's great for those regulatory agencies. I mean, they're getting a bunch of
They're doing their job.
Fine money coming. Well, I don't know that I'd go that far. I just, frankly, I just don't know about why this huge of a fine had to be paid. But anyway, that's not my concern. My concern are the agencies, including the CFTC, that are still going after JP Morgan, and what could result from that if you have admissions of wrongdoing, if you have them held liable for things. That can make things stickier. And that actually can stem out to other agencies going after other banks and make that make more trouble when those agencies are going after those banks. Civil suits could get higher, all this kind of stuff. So I think that's the bigger worry. And it's also, the other worry has nothing to do with what they're paying out for the London Whale. It's whether there were control problems that led to the London Whale and whether those have been fixed. The problem is that we won't know that. We don't know that right now. We won't know that for years to come. So it's really over the next 5 years, over the next 10 years, does JP Morgan have another breakdown of this type? That's what the concern is, not paying out $920 million right now.
Right.
Final headline here. Again to Bloomberg, U.S. home buying math bolstered by Bernanke's surprise. You can't get away from the Fed today. This is all about the interest rates falling, making home buying more attractive.
I mean, that was really the main impetus behind QE. And when we really get down to what's it going to do in the end, it's really to support the housing market, allow people to refinance. And we've seen...
Which it seems to be doing.
And yeah, it did for all of 2012, most of 2013. That's now really falling off. I think it's down, some 60, 70% from its peaks, the refinancing levels. So by keeping rates low, by staying with the stimulus, I guess they're hoping to, those people that are now becoming, I guess, above water on their mortgages, it'll give them the opportunity to maybe refinance at these rates. So it makes sense that they're sticking with this and trying to help the home builder, and hopefully it continues to get better.
Well, in terms of what it'll do, one of the things that we are starting to see but hadn't really seen is that usually when we come out of a recession like this, the housing market will help lead the recovery. It creates jobs, it pushes up the value of people's homes, makes them feel wealthier, that increases spending on the homes. We haven't really had that. And so to the extent that the housing market continues to recover, continues to move forward, that helps out. And as far as the banks that we like to follow, this is kind of mixed news, because on the one hand, the lower interest rates could keep the refi boom going a little bit longer. The banks, got to think about Wells Fargo and JP Morgan up there in particular, because they're the leading mortgage underwriters. They earn fees on those when they sell them off to Fannie and Freddie, and that could be a good thing if the refinancing continues. On the other hand, spreads have been so thin, higher rates would have probably helped spreads, so this forestalls that. And that spreads out, the spreads issue goes to all the banks. And then on a similar note to the spreads, when we think about insurance companies, they're investing all of their money, or a lot of their money typically, in fixed income securities. As long as fixed income returns or interest rates stay low, that makes it more difficult for them to earn money.
Yep. All right, we'll move on to our next segment. We'll do a little rapid fire headlines here. First one we're looking at over at the Wall Street Journal. Headline is Investors Bet on Housing Recovery Via Mortgage Insurers. So we just talked about the housing market. This is kind of a side investment here in terms of these are companies that provide mortgage insurance for those people that don't put down 20% or the minimum.
Which I'm bullish on. I'm always bullish on people not putting down 20% on them.
Of course. The pure plays in this space are MGIC, Radian. That's really their core business there. But the article also mentioned the Genworths and even AIG, which has a unit that focuses on mortgage insurance there. If I was interested in this business, which I'm not particularly, I would probably lean towards Genworth and AIG rather than a pure play on the space. I think it could be an attractive business, but I don't know if it's something I want to.
If you believe the story, I think you've got to go with Radian and MGIC, because that's where you get the real play from. But I'm kind of with you. I don't know how much I'm feeling that business over the long term. Look, going to the LA Times, we've got a headline: Freddie Mac 30-year mortgage rates fall to 4.5%. Fed helping. Quote from that article: the average rate for a 30-year fixed mortgage fell from 4.57% last week to 4.5% this week, according to Freddie Mac's survey of lenders. This actually took place before the Fed made its announcement, so we could see even more action that way. Lower rates, what are you going to say? Lower mortgages.
Right. Next one we're looking at is from DealBook. Blankfein discusses Goldman's support of SAC Capital. So there's an interview with DealBook and CEO of Goldman Sachs, Lloyd Blankfein, and he talked about supporting SAC Capital despite the indictment, but he also had some thoughts on just the recovery, and he was bullish. Not full-on bullish, but he said he was encouraged by what he continues to see the rest of the year and the rest of the coming year. So when you hear someone at the top of Goldman who deals with a lot of clients, that should be good news.
And finally, or not finally, this is my last headline. FT has a headline: global banks look to share back office costs. Here's a quote from Samir Asaf at HSBC. He said, "We all do the same things ourselves without creating competitive advantage. There's room for greater collaboration." Basically, there's been a lot more technology spending over the last number of years by major global banks. They've all been doing that themselves. They've been bearing the costs themselves. And now as capital ratios have gone up, as the environment has become a little bit tougher for earning, they're thinking, how can we cut costs? This is one way to do that.
Last one. This is the last
This
one
is
here.
this is the official last one.
From American Banker, long overdue housing finance reform within grasp. This is talking about the bill from Bob Corker and Mark Warner, and it's authored by none other than Bob Corker and Mark Warner. So they're really putting their case forward here as why they think their bill is the right way to move forward and to get rid of Fannie Mae and Freddie Mac as we know them today. We spoke with Chris Mayer, who's the professor of real estate at Columbia Business School earlier this week, and he thought this bill looked pretty good. He thought this was a reasonable balance about what housing finance needs. So we'll see if the senators are successful.
Reasonable never works in Congress. That's just crazy.
We'll see.
All right, moving on. I am running a real money portfolio on Fool.com. Readers can follow along with that. There it is. You can look it up. It'll show all of my picks. It'll track my performance. It'll let everybody know just how horribly my portfolio does if it blows up. And today I am getting ready to add another position to that portfolio. This will be my biggest position in that portfolio so far.
What are the positions so far?
So far, I've got Markel, the specialty insurer. I've got Platinum Underwriters, which is a reinsurer that I believe has very good capital allocation policies. And I have JP Morgan, which I think is a great collection of banking businesses that is undervalued right now.
And the mandate of this portfolio is financials focused. Viewers might be thinking that's a little heavily weighted to financials.
It is heavily weighted to financials, and yes, that is the target of the portfolio. So thank you for pointing that out. Today, I am going to add another insurer to the portfolio. So this will be my third insurer to the portfolio. This is a giant insurer. This is a global insurer. This is an insurer that has a brand that is known all over the world, and it's very strong businesses, and yet it's trading at 3/4 of its book value. And putting those pieces together, the astute financial stock watcher might put it together that I'm talking about AIG. And the astute financial stock watcher might also wonder, well, hey, Matt, aren't you a little bit late to the game on AIG?
One of the top hedge funds holdings.
Exactly. Bruce Berkowitz has been in AIG a while. Seth Klarman, one of the really revered value investors, he came into AIG more recently, but that was at the end of last year, and the stock has had a pretty nice run since then. Sure, this is later than you would want to be. You'd want to be in it when it was cheaper. And I was actually in my personal portfolio, but I still think at 3/4 of book value, there's still room to go with AIG, still plenty of room to go. And the thing to think about here is, I don't think that 1x book value is necessarily going to be the right valuation for AIG. So I think you can think over time about that potentially trading at above book value. But I think getting to book value is a pretty reasonable expectation. But the other part of that is that along the way, as we move towards AIG 1x book value kind of valuation, there's also the continued adding to book value. So if we look at the second quarter, book value was up for the second quarter year over year by 9%. And that was despite the headwinds on the investment portfolio. So as the interest rates went down, that hurt the investment portfolio of AIG, other insurers, other banks. This wasn't an AIG only issue. So 9% year over year book value growth, book value per share growth.
And when we talk about book value, that's another word for just the shareholder equity. So what's falling to that bottom line? So year over year, 9% is to that shareholder equity bucket.
Exactly. So you've got this path towards 1x book value, and in the meantime you have the growth of the book value. Add those two together, I think you get really nice potential returns from AIG stock. Now, in terms of what I'm watching, what I like, what I'm watching, and what other investors should be watching with AIG, let's look at 3 things here. Number 1 is the wind down of the derivatives portfolio. This isn't going to stay on my radar really much longer at all, because AIG has essentially done this. So when we look back to the financial crisis and, well, what got AIG in so much trouble? What put AIG in a position that it needed a huge bailout, that it sullied the brand, at least for a little bit, and frankly got it was trading at a half or less times tangible book value for a while, and even now at 3/4. It was the financial products division and some really bad investments that division made. that division and the investments in that division have essentially been wound down to a very large extent at this point. So I will continue to watch as that progresses just a little bit further, but that's a story that's done with.
So there might be some hiccups in that area, but nothing that's going to really dent the shareholder equity.
I'm not even really concerned that they're, well, I would hope not, but I'm not even really concerned about hiccups in that area. The exposure is small enough now that I don't think that there's really much of anything to worry about there at this point. Combined ratio for property and casualty insurance, that's a number 2 thing that I'm going to be watching. AIG has exposure to property casualty insurance. They're also a life insurer. As you mentioned earlier in the show, they're also a mortgage insurer. And for now, they also still own an aircraft leasing business, financing and leasing business. They're trying to offload that, whether by sale or IPO. That I'm convinced will happen in about a year. But property and casualty insurance made up about 69% of AIG's 2012 revenue. So this is really, really important to the company. And the underwriting hasn't exactly been stellar over time. And what the combined ratio tells you is whether the underwriting is making money. At 100, a combined ratio of 100, you're essentially break even on your underwriting. And that's fine. It's okay to break even on that, because what you're doing in the meantime is you're holding policyholders' money, and you get to invest that, and you get to keep the returns on the investments in the meantime. So that's how an insurer can make money. So you break even on the underwriting, and then you make money on the investments. If your combined ratio is under 100, you're actually making money on the underwriting and you're making money on the investments. And so that's an even better situation.
Right.
So when we look at insurance companies like Markel, like Berkshire Hathaway, historically, they've made money on their underwriting and they've made money on their insurance. That's why they're such great operations. If you're above 100, you're losing money on your underwriting. It can be okay if your investing is really great, but your returns are just not going to be that good. And if we look back to AIG over the past few years, 2010, combined ratio of 116.8. 2011, combined ratio of 108.8. 2012, combined ratio of 108.6. That is no bueno. That is not good. That's not what we want to see. However, if we look at the first 6 months of 2013, the combined ratio was 100. So it's starting to move in the right direction. We're starting to see results. I chalk that up a lot to the leadership of Peter Hancock at the Property and Casualty Insurance. He's leading that division, and I think he's doing a really good job, and I think we're going to continue to see improvements and stabilization of the underwriting results.
And it's important to note, too, those you mentioned the last couple of years, a lot of those policies were written before the new management came in, so it's kind of legacy before the culture has been redone a little bit. So that stuff will slowly wind down.
So without getting too wonky about it, there are big differences between insurers and how long these policies stay in force. If you think about an auto insurer, those turn over very quickly. So you see the results feed in very quickly on an auto insurance policy. It's really 1 year, you'll see how good your underwriting is. For business insurance, catastrophe insurance, other kind of what they call long tail insurance, you write the policy, and then it's over the course of many years that you actually see it play out. How good did we do on underwriting this? So that's the property and casualty side. And then the number 3 thing I'm going to be watching is the assets under management at AIG Life. Well, it's AIG Life and Retirement. So this is the second biggest segment of AIG's revenue and income. And it's basically a retirement products. This is people putting aside money in annuities, fixed annuities, variable annuities, mutual funds, other types of retirement plans. These are government retirement plans, company retirement plans, individual retirement plans. They have a huge distribution network and a huge network around the world of customers. And what we want to see is this the assets under management go up over time. That's what we want to see from any investment management kind of retirement business. We have seen that. It hasn't been great. If we look back to 2009, we've seen about 27% growth in assets under management since 2009. So if you put that out over the number of years, it's not incredible, but we've seen that growth start to accelerate. And so for the first, at June, at the end of the June quarter, there was $294 billion under management or in products, assets under management at Life and Retirement. That was up 10% year over year. So what this tells me is that the business is still strong, the brand is still strong, the distribution network is still working. So the bones and the core of that business are still working, it's still growing. That's what I want to see. And On the periphery, just to finish up, on the periphery, one other thing that will be very important over the next few years is leadership. Robert Benmosche is currently the CEO. He's done a good job turning the company around, but he's going to be stepping down over the next couple of years, over the next few years. Peter Hancock, like I was saying, he leads the property and casualty insurance side. I think he's a pretty good bet for the next CEO. I would be pretty happy to see him in there. Jay Wintrob, who runs the life and retirement business, he seems like a pretty solid choice too as a potential CEO candidate. So I wouldn't feel too bad if he went in there. There are probably some other dark horse candidates, but those are the two guys that I'd be looking to step into that role.
Great. Well, we'll be holding you accountable for your pick.
You will be holding me accountable. This AIG, once I make the trade, once I put this in, this will be the largest position in that real money portfolio once I make the investment. So keep an eye on that, and hopefully it does not fall flat.
We'll see.
So moving on to our game for the day, we have a little fool in the blank. And let's start it right off with number 1. David, big banks are blank about the Fed decision. Fool in the blank.
I think they're satisfied with it. You mentioned this is kind of a double-edged sword on some respects for the banks. On one hand, they want to keep those fee businesses going, like the mortgage banking, where they can sell it, but they also it hurts their net interest margin. However, banks have come out and said, the lending environment is not great. There's not a lot of companies that want to borrow, especially if rates are going higher. That might dampen that demand a little bit more. I think an executive for Regions came out and said the commercial lending that we're seeing is basically replacing old equipment. It's not necessarily expanding new production. So I don't think the economy is quite yet there for banks to lend at higher rates. So I think they're satisfied.
I'm gonna steal your answer, but I'm gonna add a qualifier to it. I'm gonna say they're grudgingly satisfied. What this indicates, and what I hate about this whole situation, is we're essentially cheering a result that confirms the Fed thinks that the economy is not in a good place. Mm-hmm. So we continue the monetary support, but it also means that the economy is not in a good place. So I think the banks probably are relatively satisfied with it, but would rather that this wasn't necessary.
Right. All right, going on to the next one. When first sizing up a bank, blank is a good place to start.
I would say the 10K is a good place to start.
It's a little daunting.
It is a little daunting. Well, let me pick out a couple sections of the 10K to start out with. There's business section, management discussion, and analysis section. What I'm typically looking for right off the top is whether the strategy and whether the competitive advantage and the differentiation of the bank shines through in how the bank talks about its business.
I'm going to go a little more specific. You can find it in the 10K. I'm going to look at the bank's segments. Just what does the bank do? Do they focus on consumers, retail banking? Do they focus on investment banking? Do they focus on commercial banking? So I would go to the segments. They'll have it all broken out there. What's their main focus? Where are they getting most of their revenue?
Okay, number 3, concerned JP Morgan investors should blank. David, fool in that blank.
Turn off the news, except this show. You can keep this show on, but don't listen to the news. Your local news is going to say JP Morgan, Wall Street fraud, billions of dollars. It's not going to make you feel great. This is still a bank that's making over $20 billion a year in profits. They should turn off the news.
I think they should sell.
No, to create more opportunity for you?
Yeah, exactly. No. I think that investors need to understand the situation, and if you're truly concerned and think that this shows a breakdown in JP Morgan's management and that this is going to endure, if you're not comfortable with management, I think you should sell. If you're not comfortable with the way the company runs its business, you should sell. I don't have that concern, so I'm not going to be selling. But I think turning off the news is probably a good idea too.
All right, last one we got is, I am blank. Janet Yellen is the front runner. What do you think?
Confident.
Confident.
I am confident that Janet Yellen is the front runner, and I'm so confident that I am kicking myself that when the odds were higher on her on what was it, Paddy Power?
Yeah,
it was a betting site that had odds on this. Man, I should have just bought put tons of tickets on Janet Yellen. How about you?
I am somewhat disappointed. Not that I think she could do a great job. I'm disappointed because I think if Larry Summers would have got the nomination, the market could have freaked out, dropped several percentage points, created a buying opportunity.
You're a jerk, man. That's the problem.
So I think she'll do a good job, but I was hoping for
do a great job.
I was hoping for a stupid overreaction. Doesn't look like we're going to get it.
All right. Finishing off as we always do in the Twitter sphere, David, kick us off with the first tweet.
First tweet we're looking at is from, it's a twofer. I know you love twofers. From Turtle first, and then Elliot Turner. He says, insurmountable problems can be conquered sometimes in just a few years with solutions no one could predict. Then Elliot says, don't you know the guy trying to find a cure for cancer is going to say, nah, why bother with cures? We have more QE. I think this hits it perfectly on the head. QE is important in the short run, but over the long term, if you're optimistic about people innovating, inventing new things, it's not going to matter. Do you agree?
Well, if there's no QE, what are we going to talk about here all day?
Okay, that's true. It's not fun talking about new innovative things, I guess.
Well, what's new and innovative in banks? Let's just root for QE. We'll continue to talk about QE. No, on a serious note, I agree. Even when we think about the banks and the insurance companies, basically every other factor is going to be more important than what the Fed does with the QE.
Right. Next one we're looking at is from our own Jordan Wathen. He has some good tweets out there. So follow Jordan. He's at JWTHN. How many businesses would you lend your money to for 100 years? I can't think of any, not one. And I think he was referencing the fact that J.C. Penney raised money back in 1997, I think, and it was a 100-year term. So he was saying he can't think of one today that he'd feel confident. I was trying to think of one. I think you could maybe go with Coca-Cola, maybe, just because of those distribution channels. I think that's going to be hard to...
I'll tell you who it wouldn't be. It wouldn't be J.C. Penney.
Okay, that's for sure. But is there one that comes to mind, or are you kind of stumped as well?
Well, it's a pricing thing. If you price the bond right, if you give me the right return, there are probably a good handful of businesses that I'd be willing to lend to for 100 years. Berkshire Hathaway would potentially be one. Coca-Cola would potentially be one. Pepsi would potentially be one. Markel would potentially be one. But again, I mean, that's a big risk, lending over that time period. It's a risk that the company stays in business. It's also a risk from the interest rate environment over that huge period of time. Mm-hmm. But if you give me the right rate of return, then I might be pretty satisfied with that.
Uncle Sam might not be bad either. I think he'll be around. The taxing business never goes out of style.
No, the whole U.S. economy is collapsing, so I would never lend to that.
All right, the last one we're looking at is from Kate. She's at Kate Hall. Look, whoever invented pumpkin bread needs at least one Nobel Prize. Matt, are you a fan of pumpkin bread? Are you cheering that fall is almost here?
At least one Nobel Prize. I would say 3 to 5 is probably more in the range. And I'll tell you what, get one to Starbucks at the same time for that pumpkin spice latte. That is good. And that reminds me that I have not been to Starbucks.
It's not fall yet.
It doesn't matter. It doesn't matter. We already discussed this. I don't care the moon date for fall or whatever it is. It is fall. It's cool outside. It is fall. The pumpkin spice latte is in at Starbucks. I need to go get one. Maybe I need to do that today.
Fair enough. Again, as always, you can tweet at us. We are at TMF Financials. You can tweet your questions, comments, and we'll address them right here on the show.
All right. David of the Electric Blue Pants. Folks, thanks for watching. We will be back tomorrow morning, probably talking more about the Fed and definitely talking about more of the stocks that you should be watching and potentially buying. Thanks again for watching. Take care.